$100 invested in the S&P 500 in 1980 would be worth $14,847 today. But here's what nobody tells you. Someone who added just $100 every single month during that same period, they'd be sitting on $1.2 million. The difference isn't luck, it's a system. By the end of this video, you'll know exactly how long it takes to turn $100 into $100,000 at different contribution levels. Understand the 3 investing mistakes that cost average Americans $427,000 over their lifetime, and have a clear plan. You can start tonight with your phone. Quick note: everything I'm sharing is for educational purposes only, not financial advice. Historical returns don't guarantee future results. Always do your own research and talk to a licensed financial advisor before making any decisions with your money. Here's a number that should make you uncomfortable. 63% of Americans can't cover a $500 emergency. But here's the flip side. You don't need $500 to start investing. You need $100 and a calculator. Let's run the actual math. Starting with $100, adding $200 per month, at the S&P 500's historical average of 10.26% annually, you hit $100,000 in 17.8 years. Bump that monthly contribution to $400. You're there in 12.1 years. At $600 monthly, just 9.3 years. Most people think building wealth requires a massive starting sum. Wealthy people understand something different. Consistency beats lump sums nearly every time. A Princeton study found that regular investors outperformed those waiting for the right moment by 2.3% annually. That gap compounds into hundreds of thousands. 73% of beginner investors pick the wrong account type and pay 37% more in fees over their lifetime. Your platform choice matters more than your first stock pick. When you're starting with $100, every dollar counts. Commission-free platforms have fundamentally changed the equation. 10 years ago, a $7 trading fee on a $100 investment meant you were down 7% before the market even opened. Tools like Robinhood allow fractional share investing, meaning your $100 can buy pieces of companies trading at $500 or $1,500 per share. AI-powered features within these platforms now analyze your risk tolerance and suggest allocation strategies. Betterment uses algorithms to automatically rebalance your portfolio as market conditions shift. The platform you choose should offer 3 things: 0 commissions, fractional shares, and automatic recurring investments. That third feature is the real wealth builder. Here's something uncomfortable. You are your biggest investing obstacle. Behavioral finance research from Dalbar shows the average investor earns 4.25% less than the S&P 500 annually, entirely due to emotional decisions. The solution? Remove yourself from the equation. Set up automatic transfers from your checking account to your investment account every payday. The money moves before you see it, before you can spend it, before you can talk yourself out of it. 1. Finance lets you create pies, automated portfolio allocations that invest your deposits according to percentages you set once. Acorns rounds up your daily purchases and invests the spare change automatically. One Yale study found that people who automated their investments saved 81% more than those who invested manually. Not because they earned more money, because they actually followed through. Most people spend weeks researching individual stocks for their first $100. Wealthy people put that $100 to work in the first hour. Broad market index funds have outperformed 89% of actively managed funds over the past 15 years, according to S&P Dow Jones indices. An index fund tracking the total U.S. stock market gives you instant ownership in over 3,600 companies with a single purchase. Consider your timeline. Money you need in 5 years belongs somewhere different than money you won't touch for 25. A general framework many financial educators suggest. Subtract your age from 110, and that's roughly the percentage to consider for stock-based investments. A 30-year-old might allocate around 80% stocks, 20% bonds. Tools like Personal Capital, now Empower, offer free portfolio analysis that shows your actual allocation versus your target, plus hidden fees you might be paying. At $100 monthly, reaching $100,000 takes 24.7 years. But there's a pattern wealthy investors follow. They increase contributions with every raise. Here's the math that changes trajectories. If you start at $100 monthly and increase your contribution by just 10% each year, you reach $100,000 in 16.2 years, saving yourself 8.5 years. Most people upgrade their lifestyle with each raise. Wealthy people upgrade their investment contributions first. The IRS allows $23,000 in 401k contributions for 2024 and $7,000 in IRA contributions. If your employer offers any match, prioritize that account first. A 50% match is an instant 50% return before the market even moves. Consult a tax professional about which account types make sense for your specific situation. 2 tools worth looking into if you're ready to start. Robinhood offers commission-free trading and fractional shares, so your $100 can begin working immediately. The link's in the description below. Both platforms let you set up automated recurring investments, which, as we covered, is the actual wealth-building mechanism. Here's what we covered. First, the math. $100 plus $200 monthly equals $100,000 in 17.8 years at historical returns. Second, platforms matter. Commission-free and fractional shares are non-negotiable. Third, automation beats willpower every single time. Fourth, broad index funds outperform 89% of stock pickers. Fifth, increasing contributions by 10% annually cuts your timeline by over 8 years. If any of this was useful, leave a like. It genuinely helps more people find this content. Subscribe if you want to keep building, and drop your biggest financial question in the comments. I read every one.